Thanks for joining us today on The Close. I'm Marella Fernandez. Markets close in half hour's time. Let's get to the stories we're following in the BNN Bloomberg newsroom. Canada's trade deficit widened by more than expected in November. Data from Statistics Canada shows the country had a trade shortfall of $2.2 billion, with total exports falling 2.8%. Gold has been the most significant contributor to the fluctuations in exports, with large shipment declines to the UK, US, and Hong Kong. Both exports and imports of motor vehicles and parts saw a decline. Shares of Rogers Communication moving higher today after revenue and profit in the latest quarter topped Bay Street estimates. The results were helped by the telecom's investment in the Canadian sports industry. Benefiting from the Blue Jays playoff run for the full year, Rogers is projecting revenue growth of up to 5%. And Celestica, one of the worst performers on the TSX today, it's down close to 16% right now. Analysts highlighting the company's increased capital spending, as well as its disappointing full-year outlook. Celestica boosting planned capital investment to $1 billion for the year. On the upside, revenue and profit in the fourth quarter did beat expectations, driven by continued demand for AI data center technology. Shares of Canadian Pacific Kansas City are edging higher today. The rail company posted higher overall revenue in its most recent quarter and also saw non-freight revenue surge 26%, beating estimates on the downside, though. CPKC says the ongoing tariff war costed $200 million U.S. over the past year, but it was still able to control costs amid a challenging market of macroeconomic and trade policy headwinds. The TSX down 267 points on the day to 32,908, or 0.8%. Red in the U.S. as well, a 41-point drop for the S&P, down 0.6%. The Dow Jones, an 88-point loss. The Nasdaq down 324 points, down 1.4%. Stocks took a hit today on renewed skepticism about AI CapEx spending. However, my next guest says he's buying today's sell-off. Let's go to Adam Johnson, founder and author of Bullseye Brief. Thanks for joining us today.
Thank you, Marella.
So big tech bringing down the market. Microsoft, a big part of that. Apple set to report today at the end of the trading day. What's your tech play for 2026?
Stay long. By no means should anyone sell into this sell-off right now. This is all about AI capital expenditures. Companies spending a lot of money to try to build, develop, et cetera, AI platforms, which ultimately they think will drive revenues and therefore profits and growth. I'm on board with that. And as far as this notion, Morella, that the companies can't afford it, that they're spending too much, they can afford it. If you look at the big guys, the mega cap tech stocks like Google, Amazon, et cetera, they're going to spend about $550 billion. I know that sounds like a lot of money to spend in 1 year developing AI, but collectively they have revenues of $2 trillion. So again, they can afford it. In fact, the average S&P 500 company is only spending 1% of revenues on AI. They too can afford it. And I would argue that with S&P 500 earnings up double digits for the fifth consecutive quarter, and with profit margins now at record highs, 13.2%, we're actually starting to see the early benefits of the AI payoff. So I would tell these AI companies, and they don't need me to tell them this, but I would say keep going, keep spending, do it wisely, and make sure, as Mark Zuckerberg did of Meta, that you explain to investors the payoff, that you make it tangible. That's why Meta is up today. He did a very good job at that. The others haven't. Make it tangible for people, and I think they'll forgive you for it, and they'll actually come in and buy your stocks.
Okay, let's take a look back at what you've seen on earnings season so far. Tech is part of that. They're just beginning to report. So can you give me a wider lens here on what you've seen so far?
Well, the banks kicked off earnings about a week and a half ago, and that's always important. Yes, I know the banks are the first sector to report earnings, and so it's like a sort of a an early warning on your radar. But what this really means is that the economy is doing a lot better than people think. When banks are making money, I mean, I know it sounds cliche to say this, but money's what makes the world go round. And when the banks are seeing liquidity and they're seeing high credit quality and they're seeing growth and they're seeing people who want to borrow, whether that's individuals or businesses, that bodes very well for the economy. So I like what I'm seeing right now in a broad sense. If you sort of step back and say, what's the big picture, as you just did, the big picture is very strong, and it's a lot stronger than people think. Officially, GDP is growing, the economy at 4.2%, which is very strong, by the way. The 50-year average GDP growth is 2.9%. Again, we're at 4.2. And the Atlanta Fed estimates, using their GDP Now real-time forecast, that we're growing at 5.2%. That is very strong. So you couple earnings growth with GDP growth, and yes, I am very comfortable. I like what I see, and it's why I've been buying on this, what is, quite frankly, a very ugly day for tech.
Okay, let me ask you whether or not you thought the Fed was right to hold the line on the rate for now.
I'm okay with it. I'm not thrilled with it because as a stock investor, I like lower rates. Lower rates make future earnings worth more by definition. So yes, of course, I, as a stock picker and a stock portfolio manager, would like to see lower rates. But I recognize that what Jerome Powell is doing, number one, is trying to protect his legacy, which is not easy given the heat he's getting from the White House right now. But he's also trying to just give the economy a little more time to make sure that inflation doesn't suddenly rear its ugly head all over again. I don't think it will, because in spite of tariffs, inflation has come down to 2.7%. It's not quite the 2% target, but think about it. Consumer prices at the high were 9.1%. So to come down from 9.1 to 2.7, that's pretty darn good. And even if we're not quite at the 2%, we're getting there. And what Jerome Powell is effectively saying is, before I take more interest rate increases that I put in a couple of years ago, before I take them back, I just want to make sure that inflation doesn't bounce. So I understand what he's doing, and even if I'm not entirely thrilled with it.
Do you feel like the labor market is still a concern, or have those concerns passed for you?
I think they've passed. And I tell you why. We saw an uptick in unemployment to 4.7%. That was a concern. And I mean, you can't, there's no way around that. That was a concern. Well, it has come back to 4.4, and we're going to get unemployment a week from today, the latest unemployment, and it's supposed to hold steady at 4.4. The U.S. economy is still generating somewhere, I shouldn't say generating, creating somewhere between 50 and 70,000 jobs on a monthly basis. That's not as high as it was. I mean, it was up around 175 to 200. But guess what? That's also inflationary. When you have that kind of job growth, by definition, people are going to ask for more money. Sure, hire me, but I want to be paid more. And that may be good for people, but it's not great for inflation. So the fact that the rate of job growth has backed off is good for inflation, and because we still have job growth, that's good for the economy. I don't want to sound like a Pollyanna, like Goldilocks. It's just right. It's not just right. Nothing's ever just right. But I'm okay with where we are.
Okay. That being said, do you expect cuts later this year?
Oh yeah, I think everybody does. There's no reason to think we wouldn't get cuts. And as for the timing, I think the market's starting to gravitate towards one cut in June and one cut in December. Curiously, the White House says that it's going to name its new Fed chair next week, which is an attempt, I think, to kind of box out Jerome Powell, make him a lame duck. And you can rest assured that the new, as yet unnamed Fed chair is going to be someone of very careful choosing, who is right in line with the president. And we know President Trump wants lower rates. Lower rates makes everything cheaper for everybody. that solves the affordability question, and it certainly helps him and the Republican Party into midterms. So that's part of the story. And so I think he wants to get someone out there in the public view who's going to start giving speeches about lowering rates. And the bond market's not going to wait for this new Fed chair to take office in June. It's going to start pushing rates down, and that could actually solve a lot of problems.
Okay, I do want to get an idea of what other tailwinds you see for the market. Obviously, deregulation is expected in the next part of the year. Obviously, you talked about the rates cuts that you think are coming down starting in June. What else do you see as acting as a tailwind?
I think oil prices are up right now on the assumption, whether it's right or wrong, that the U.S. is going to go into Iran again. We've got a carrier task force sitting off the coast of Iran right now. There's also talk that Saudi Arabia has told the U.S. don't do it. So stay tuned. But I think that's why oil is up at $65. You take that issue off the table, and or you bring onto into the picture peace in Ukraine. I know we've been talking about it for a long time. And I think you actually start to make the case for oil down in the mid 50s. The world is very well supplied. The U.S. is producing the most ever, ditto Saudi Arabia. And if we get peace with Ukraine, then all that embargoed Russian oil comes back on the market. So lower oil, again, that's part of the deflationary story. I think that's a tailwind for the market. I think artificial intelligence, despite all the hand-wringing over AI expenditures by big cap tech companies, I think that is a huge tailwind for the market. And I think that's the reason profits are rising and that margins are at record highs. I think we're starting to see the early benefits, the early payoff, if you will, of artificial intelligence, and it's still early days. And then you bring robotics, which is just another way of saying artificial intelligence. That's a use case. You bring robotics into the equation, from autonomous cars to autonomous trucks, and not just on the roads, but in factories. That's happening all over the country. And you heard Elon Musk yesterday on the Tesla phone call, earnings call, saying that he's going to replace 10,000 workers with his 10,000 Optimus humanoid robots. Within the next few months, he's converting one of his factories to start going full production on those. He wants to get to 1 million robot run rate. They're only going to cost 50 grand. He'll make a 20 grand profit on each. And that's going to change the way factories assemble cars, put all sorts of things together. I mean, who knows? I don't think we're going to see robotic waiters at a restaurant anytime soon. But again, that all speaks to productivity.
I've already seen robotic deliverers, servers at a restaurant, so we're already on the way. Adam Johnson, thanks for joining us. Appreciate it. Coming up, Rogers Communications beat estimates in its latest quarter. We will look at what is leading that beat when we come back. The Blue Jays' run to the World Series helped the bottom line for Rogers Communications. The company beat estimates in revenue and profit for its latest quarter. Aravinda Galapathege, Managing Director and Institutional Equity Researcher at Canaccord Genuity. Thanks for joining us today.
Thanks for having me.
So how much did the sports assets contribute to Rogers' beat? I know they are going all in for sports.
Yeah, I mean the media EBITDA, which encompasses the sports assets, posted an unusually strong $220 million in EBITDA in Q4. I would say the beat was almost entirely the media assets. Wireless was a touch better, so call it $10 million better than we had, but the media assets were materially better, maybe 50 to 60 million. So a good chunk, like the vast majority of the beat were the media assets. And it was, the Jays run was a big factor, but there are a couple of other items as well, including the ramp up of the Warner Brothers Discovery channels that they had transitioned from Chorus. And then there was the acquisition of MLSC, which was also a substantial factor. So all that together made the difference.
Okay, so how would you qualify the beat in their latest quarter?
I would say that it is still a net positive, because when you look at the guide, I mean, you have to look at the guidance that they gave for 2026 alongside that beat. And the guidance was about 0.5% to 1% better in terms of revenue and EBITDA growth than I think ourselves and the street expected. So, it's not a dramatic beat, but it is, a touch better than I think what the market in general expected. So, I think the right number to properly characterize it is to think of it that way, call it maybe 0.5% to 1% better in terms of revenue and EBITDA. And then if you look at free cash flow, it's a bit more than that.
Okay, so Aravinda, let's talk about the more traditional part of the business, the wireless and the cable. What does the future look like for that end of things?
It's still, it's a slow recovery is the way to, I think, characterize it. As you probably know, it's been under both sides of the business have been under a fair bit of pressure, in particular the wireless side of the business. A business that used to grow 4-5% in terms of service revenues is at zero today. But I think the positive news is that the worst appears to be behind us, and we would expect a recovery through 26 back up to, call it, +1. I think that is the reasonable way to think about it. And then the same goes for cable. Cable is also around that flat, year-over-year flat picture. So a lot of the work that needs to be done is on the cost side, trying to create some operating leverage. So it's a case of tracking along that sort of slow road to recovery. And obviously tracking involves checking, seeing how the volumes perform, but also the level of discounting that's happening in the market. So that's probably the best way to think about it.
Talk to me about what risks the space has this year. So not just Rogers, but the telecommunications space. What would be the biggest risks for them in 2026?
Yeah, so the first thing to consider is the promotional intensity in the market. That is one of the biggest factors that caused, significant damage to the sector over the last 2 years. So the competitive dynamics between the three incumbents and obviously the insurgent entrant here, Freedom, which is owned by Quebecor. The level of promotional activity got out of hand through 24 and in late 23, but we saw some rationality through most of 25. But we continue to see bouts or skirmishes of some pricing action. And that is the risk. If that promotional intensity breaks out and the companies are forced to discount more aggressively, that compromises that slow recovery that I talked about. That's number one. The second thing is the balance sheet. What investors expect of these businesses is for them to be good defensive stocks, good defensive businesses. And that means keeping your balance sheet in good shape. And that hasn't been the case in the past. Balance sheet leverage of all these companies have spiked because of acquisitions, because of expensive spectrum auctions, and a number of reasons like dividends and so forth. So what you want to see is the divestitures that all these companies are talking about actually play out and be executed upon. If those divestitures don't occur, then the balance sheet issue becomes central again. I would say those are the two main things to consider.
The company, as I mentioned, wants to very much capitalize on all of the sports products that it now owns and the assets in that field. Has it shared at all how it plans to do that? And is that a 2026 kind of announcement that's expected?
Yeah, they have shared. They've discussed, with the analysts, with the street in general. So the plan is for Rogers to, first of all, completely consolidate MLSE. MLSE, as you know, own the Raptors and the Leafs and a bunch of other sports assets. And there's another position of 25% in MLSE that's owned outside of the company. That needs to be consolidated. That would be the first step. And then you'd have a fully owned sports co, which was arguably worth between $15 and $20 billion. Call it 17 is our best estimate. The plan is to drive a transaction that would potentially divest a minority stake, and that stake could be 25 all the way up to 40% of that sports co. And those proceeds would be material in supporting the deleveraging plans of the company.
All right, Aravinda Galapathige is the managing director and institutional equity researcher at Canaccord Genuity. Thanks for your time. I appreciate it.
Thank you.
Canadian food conglomerate Empire is going to shut down its consumer fulfillment center in Alberta. We'll tell you why when we come back. Empire says it's going to shut down a Sobeys fulfillment center in Calgary. For more on the story, let's go to BNN Bloomberg's Lindsay Biscaya. She joins us now. What's going on?
So Empire is just to explain, Empire is the parent company of Sobeys. And this warehouse was part of the grocery delivery, online delivery service that Sobeys has, Voila, which like we've seen the trucks here. I believe they're like a light blue color. We've seen them in Ontario. But now apparently sales out west, when it comes to people who are trying to order and deliver their groceries online, they're not doing so well. So this warehouse closing down in Calgary. There's actually another small one in Edmonton that's also closing down. And there was plans to build another one in Vancouver. Those plans have been paused for a couple of years now, and they're still paused today while Empire looks at this. The shares of Empire are actually doing quite well today. They were up even before the bell this morning. They were up like more than 8%. They're still pretty good at this time. So obviously this is good news for the company. But Empire is saying it is going to be taking a $750 million write-down on the business, saying the results from the online grocery expansion have not met the company's financial expectations. And so Voila will continue to operate here in Ontario and in Quebec as well, which are the other two provinces it operates in terms of Alberta, and an expansion into BC as well. Not so much at this time. We know that Sobeys has some third-party partnerships, like with Uber Eats. They're beginning another one with DoorDash, so people who live out west in Calgary, Edmonton can expect to see that soon. But in terms of Voila, it's not happening out there.
Okay, did they give any details or share more on why? Are people just not using the service much?
It's interesting, like not really. People aren't using it as much. What is interesting is this warehouse was built about 3 years ago. So when you think about that, we're still kind of in the pandemic era. And so a lot more people were ordering their groceries online rather than going out to get them. But we did hear from the CEO of the company back in 2024 when they paused the Vancouver warehouse construction, saying that basically people just aren't shopping as much when it comes to online, and that it's actually hurting their brick and mortar sales because they still do quite well with, foot traffic going in to buy their groceries. In terms of why this might be happening as well, you might look at like a different population in Calgary compared to Toronto or Montreal, where there's just more people, there's more density, maybe more
We're
people.
just so much more demanding.
It's harder to get around. Like a lot of people, like maybe a lot of people just don't want to go out and get their groceries.
I need my cheesies right now. Okay.
I've never done it. I would rather go pick out my own stuff, but apparently a lot of people would in Ontario and Quebec rather shop online. But there you have it. I mean, it's just not for people out west, apparently.
All right, Lindsay Biscaya with that update from Empire. Coming up next, the closing bells on Bay Street and Wall Street. Here are the closing bells for the end of the trading day. At the Nasdaq today, Ethos ringing the closing bell. In New York, the cast of HBO's Industry ringing the closing bell. And in Toronto, AME Roundup 2026 doing the honors. You're watching the close on BNN Bloomberg. I'm Marella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX Composite, 159-point drop today. That's almost half of 1%. Still above 33,000 at 3316. The S&P 500, not a material move. But the Nasdaq has a 172-point drop today. That's 0.7 of 1%. Let's take a look at the movers in Toronto. We're going to start here with Celestica. It is down 13.5%. That's 63.23, a loss per share, taking the share price to 403.89. We're going to Vizsla Silver down next, 14.9%, short of 15% drop. After a security incident at one of the mines they have in Mexico, so $1.38 loss per share for Vizsla Silver. G Mining Ventures also moving down today, 12.3%. That's a loss of $6.43 a share. And Energy Fuels, also a loser on the TSX today, 10.5% down, moving the stock price to $33.59. Orla Mining also losing today, 13.5%, taking the price to $22.90 today. Let's get to gainers. Canadian Pacific, Kansas City today gaining 5%, reversing an earlier trend. So $4.99 up, almost $5 flat to 102.27. And Rogers Communications, as we spoke about earlier, trending up today, 5.7% gain for the company on earnings and a beat as a result of its sports assets. Let's go to Bloomberg's equities reporter, Stephanie Hughes. She has more on what happened with Rogers today. Stephanie, tell us more about the earnings.
Yeah, that's right, Morella. So Rogers did post a sizable beat, and that sent the stock price moving upwards by over 6% at its highest point today, which marked its biggest intraday gain since July. So it's been a few months since we've seen this amount of enthusiasm around those shares, and that's because the telecom company posted earnings per share of $1.51, and that came ahead of what analysts were expecting, which was closer to $1.42, and that was entirely driven by the company's media segment, since Rogers expanded its sports empire last year by doubling its stake in Maple Leaf Sports and Entertainment. That and the success of the Blue Jays team last year really fueled that segment, which makes sense just given the hype at the time. I remember any bar in Toronto with a TV was just basically packed to the brim, so it was a really interesting moment. So that helped media revenue fuel by 126% since last year, doing most of the heavy lifting, while the wireless and cable segments were relatively flat because of a population slowdown from federal government's immigration curbs. So those have been trying to get a little bit more traction there, but it's just been much more competitive environment. But we can really just point to that sports segment, Morella.
All right. The company, of course, going all in on sports. They see it as a way forward.
Yeah, that's right. That's kind of what the tone was from the conference call. CEO Tony Staffieri reiterated the company's plans to buy the remaining 25% stake in MLSE. And he also added that the results today really set up the company to be able to pursue that stake, and added that this will help grow the company's value and help retain customers. So on the wireless side, another tone that they struck on the conference call, they said that they did lose some ground on subscriber growth since they didn't cut their mobile plan pricing to the same extent as some of the rivals did during the Black Friday season. But they plan to compensate around that by pushing further into underserved markets like rural areas, which don't have the same kind of network concentration as cities do. So all in all, analysts were somewhat positive on the results, and investors seem to be reacting well as measured in the stock price today, Morella.
Okay, let's talk about the CapEx spending concerns for Celestica, but that is what dragged that stock down today.
Yeah, interesting story with Celestica. Those shares plunged by the double digits. The stock fell nearly 15% today, which made it one of the worst performers on the TSX. And that's despite the fact that the company, which manufactures electronics components, it did report a pretty significant earnings and revenue beat. But what people were focusing on, or at least what analysts were suspecting, investors were focusing, was the higher capital expenditure reading. So traders might be looking at the higher costs that the company expects in the year ahead, and kind of getting spooked by that. They earmarked about $1 billion in strategic expenditures for their business. So you're right, even though the company or the analyst said that the execution appeared flawless and their earnings have been holding up okay, as long as I've been seeing in the earnings results there compared to estimates, traders seem to be spooked by how much Celestica might be doling out this year, Morella.
Yeah, CapEx definitely a concern for many. All right, Bloomberg, Stephanie Hughes, thanks for that.
Thank you.
Let's get to movers south of the border with Bloomberg senior equities reporter there, Bailey Lipschultz. Bailey, Southwest Airlines shares moving higher. They reported earnings that did top, but it wasn't an easy year for them.
Yeah, not an easy year for them, but management was quite bullish on the year ahead. So this does come in the wake of at least a few peers reporting lackluster results. So that helped fuel the shares to their best day on record. Also, we're continuing to see some of the kind of push changes that Elliott Management, an activist investor, had pushed for. So Southwest operating more like your traditional airlines here in the U.S. and around the world, like American, like United, where you actually select your seat in advance and you pay for bags, two things that the company had kind of hung its hat on in recent years as a big driver. But it does seem like expectations are continuing to be met, if not exceeded. And it does seem like, at least looking through the analyst reaction and also what management said on the earnings call, consumers do like that. So it does seem like people are more than happy to maybe pay up to select their seat or check their bags, things that we're a bit more skeptical of, at least from the sell side community.
Yeah, you don't have to pay for your bags when you go on a cruise line. Royal Caribbean also jumped. What drove that?
Yeah, this is a company that beat expectations. They laid out how strong their bookings were for 2026 already, just 7 weeks into their selling season, well ahead of what Wall Street was looking for. And the big question had been, how can the company continue to kind of diversify away from potential slowdowns in the likes of a European consumer? And they're continuing to seemingly do that. So biggest jump since 2022 or 2020, excuse me, words are hard, beating expectations again on that. Again, meeting and exceeding expectations. It does seem like they're continuing to find different levers to pull, but as you can see, still below the peak in late September.
Okay, let's get to Visa. I know they're reporting right now. I'm just wondering what you're seeing. That has been going sort of sideways, and people have been worried about their Visa share. So what do you see?
Yeah, we're seeing a beat on the top and bottom line so far across the board, really, but maybe a bit more modest. The big question is going to be how the company and MasterCard, who's also reporting after the bell, how they address some of the potential threats from the White House as it relates to capping credit card spending and helping kind of fight the duopoly, or at least perceived duopoly, between Visa and MasterCard. But looking through some of the statements, beating expectations, payment volumes on the quarter up 8%, cross-border volumes up 12%. So there was a bit of excitement going into year end that some of that holiday spending would continue to show kind of excitement. So again, $3.17 on the first adjusted earnings for first fiscal quarter. Wall Street was looking for $3.14. Management in the press release saying that they did see resilient consumer spending in a strong holiday season, strength in their value-added services, commercial and money movement solutions. Again, will be interesting to see how the stock performs in the aftermarket. As you can see, down about 1%, so maybe not exceeding what investors were looking for, but the big focus will be how does management address analyst and investor questions around what the push from the White House could mean for their underlying business? And again, what does MasterCard report, and how do those kind of pair up, if you will?
All right, Bloomberg, Bailey Lipschultz, appreciate the update. Thank you. Coming up next, as you saw, the major North American indexes are in the red today after a broader sell-off in the AI-related tech stocks. We're back in just a moment. Tech stocks led today's market sell-off as Microsoft declined more than 11%. The company's Azure segment showed a slowdown in growth and higher spending, of course, on AI. Let's talk to Brett Winton about this, chief futurist at ARK Venture Investment. Thanks for joining us today.
Thanks for having me.
So Microsoft, of course, tanking on overspending concerns, but are investors right to be worried?
I mean, I think that people who are betting that investments in AI are not going to yield productive outcomes are making a mistake. Generally, CapEx in AI, whether it be in space or on the ground, we think is going to generate a remarkable return on investment. And, if you look at Microsoft or if you look at Tesla, which is committing $20 billion to CapEx next year across both AI and physical infrastructure that will be powered by AI, we think those are probably going to be good return on investment decisions.
Okay, Meta's spending on AI was a concern. Why aren't investors as worried about Meta? That stock up today.
Well, I mean, I think in some ways in the prior quarter, people were pre-concerned about Meta and their commitment to CapEx for AI. I think over time, you're going to look at the tokens generated, and you can see the cost to generate a token, one of the units of output in these large language models is falling because the chips are getting better and better. And the value you get out of the tokens generating is increasing. As a knowledge worker, I use AI models all the time to make myself better, more powerful. I think people across the economy will do so, and so kind of the revenue capture off of those tokens generated relative to the cost to generate them is actually going to expand over time. I think you'll see a surprising increase in margins over time. To the companies delivering core AI capabilities to their end users.
Okay, so what is your estimate on spending on data centers and how high could it go?
Well, by 2030, we think more than $1 trillion will be spent a year. It's actually 1.3 trillion on data centers to support AI, and that's on the ground. There's an additional, possibly as large a volume of investment that's going to go into putting data centers into space. Ultimately, we think all of those are going to be good asset allocation decisions. The world is starved for compute capability right now. Anthropic and OpenAI and Google, they're all having to underserve their customers relative to what their customers want to use their models for, because they don't have enough computer chips to deliver the tokens that their customers want. So that means they are, not able to generate as much revenue as they could if they had an underlying inference data center that was large enough to serve their customers. And we think that's actually going to extend and amplify over the course of this cycle. As these models become more capable, able to deliver more compelling outcomes to enterprises and individuals, they're going to want more of it. And so we need at least that investment. And if anything, the amount of investment going into AI compute could continue to be the critical gating factor to our ability to extract kind of output out of it across not just core AI, but robotics and in the multiomics and health space. There's a huge need for AI compute to enable amazing capability.
Okay, so let's take it down a level to what can AI agents do now more quickly than they couldn't do, let's say, a year ago? And how quickly do you expect things to change? How much faster will they get?
Sure. At a kind of like for a knowledge worker level, we think that AI can deliver a 20% productivity boost to a knowledge worker. You feed information in, you get information out, you have to quality check that information, and then you ship it into production. But in some categories, it's much higher. In coding, people can deliver 200+% productivity gains. We think productivity delivery to general knowledge workers is going to triple year over year, and then at least it's kind of 2.5x year over year after that. So go from 20% to 60 to 70%, up into the kind of every hour you're spending is almost 3 times more productive within a couple of years. What does that practically mean? It means that you can ship really small pieces of software that solve a really specific problem for just you or for just your organization much easier. It means that all of the electronic agony that you, the individual, face in your life, because this thing doesn't interface with that thing, those frictions will be solved by companies and individuals delivering solutions to the market. And so I think the digital world is just going to become much easier to use, much better, and people will be more productive operating in it.
I hate electronic agony. I do admit that. Okay, let's talk about your top investment ideas right now for tech.
Sure. Well, on the public market side, we obviously have a large position in Tesla. We think that's the largest AI exposure in the world. They've taken the drivers out of the robo-taxis in Austin, Texas. We think the robo-taxi operating system platform providers, of which Tesla is the premier version, could be worth north of $30 trillion by 2030, with Tesla taking a meaningful share of that, assuming it can scale its robo-taxis. On the private market side, in our venture strategy, SpaceX is the largest exposure, and their opportunity set has meaningfully expanded as it became obvious that sticking computers into space could be a cheaper way to deliver these tokens that the world needs. And so if you think about building a data center on the ground, you have to buy the chips from NVIDIA, but you have to build the whole building, you have to buy the land, you have to get power there. All of that is extraordinarily expensive. SpaceX promises to take the chips and take all of that other spend and just put it into the cost to launch the rocket and the cost to build the satellite around the chips. And then you don't have ongoing expenses for getting additional power for the chips over time. And so it's an upfront cost that we think will prove more economical for delivering AI compute. And it'll win a lot of revenue share to SpaceX from kind of terrestrial data centers.
All right, Brett, I'm still sort of grasping the ideas of the data center in space, but if you see it, I'll have to look further. Brett Winton, Chief Futurist at ARC Venture Investment. Thanks for your time.
Thank you.
Up next, Federal Reserve in the U.S. maintained its benchmark policy rate yesterday, citing a stronger economic environment. We'll dig deeper into that in a moment. The U.S. Federal Reserve decided to maintain its key policy rate yesterday when they announced it, marking the first pause since the summer. My next guest believes more rate cuts this year will only happen if inflation shows clear signs of slowing down. Let's go to Michael Gapin. He's Managing Director, Chief U.S. Economist at Morgan Stanley. Thanks for your time.
Thanks for having me on.
Last year, the primary concern for the Fed was the labor market, and it was weakening at the time. Do you feel that concern is fully past?
No, I don't think it's fully passed. The Fed said that they saw signs of some stabilization in the labor market, but I don't think Powell sounded entirely confident that downside risk had been removed. Certainly employment growth at 29,000 jobs per month on a 3-month moving average in the fourth quarter isn't overly robust. He pointed to things like weaker job openings and so forth. But I think the concerns about, kind of an imminent slowdown in employment and a pickup in layoffs, that did not materialize. So I think they saw enough to say some of that downside risk had gone away, but I think concerns about the labor market still remain.
Okay. Are you seeing deeper signs of weakness in certain sectors over others? Manufacturing is what comes to mind?
Yeah, I mean, the two main ones, one is policy driven, that's government sector employees. So the DOGE-related cuts earlier in the year were still coming through in the fourth quarter. But in terms of kind of what the cyclical forces are saying, yes, manufacturing employment in the U.S. continues to move lower, not rapidly, but 5,000-10,000 jobs a month appear to be coming off the manufacturing sector. Construction shed jobs again recently as well. So the housing sector is weighing on activity there. So mainly on the good side of the economy. The services sector on net is kind of flat to a little higher. A lot of those gains and employment still coming in education and health, some leisure and hospitality. Outside of that, it's generally flat. So on net, a low fire labor market. But if you look under the hood, layoffs at the public sector, layoffs in goods producing sectors.
Okay. So from here on, you think it'll be more about inflation and an inflation watch?
That's right. I think the signal, at least out of the labor market, is some recent signs of stabilization. If that holds, I mean, the Fed has a more optimistic view about 2026 than they did previously. We are the same. I think the incoming data is pointing to fairly solid economic momentum. If that's the case, the labor market should at least move sideways and not deteriorate, which would mean then if the Fed normalizes its policy rate further, it's likely because inflation's coming down. And so Powell reiterated his view, his belief in the transitory story that tariffs only put temporary upward pressure on inflation. If that's the case and inflation's moving lower, primarily in the second half of the year, then the Fed can further normalize its policy rate and bring rates down further. We think that will happen. So I think it's a Fed that shifted from labor market-based cuts to inflation-based cuts.
Okay. Tax cuts, of course, will mean more money in the pockets of Americans this year. Are there inflation concerns around that?
I'd say limited, but yes. I mean, just like downside risk to the labor market has not been fully eliminated, upside risk to inflation have not as well. So far, tariff pass-through has gone about in line with expectations, but every month we're getting evidence that that seems fairly limited on net. Pass-through will continue in the first half of the year. So you'd have to argue what would then kind of be catalytic for inflation and firm inflation. And I think the answer you're pointing to correctly is the effects of the One Big Beautiful Bill Act. Could fiscal stimulus, whether it goes to consumers or corporates, make demand stronger next year? We don't think the impulse to consumption from these tax cuts is sufficiently large. We think it maybe adds about 0.2 to the growth rate of consumption next year. That shouldn't be enough to put upward pressure on inflation, but maybe we're wrong. And maybe demand is strong, the labor market tightens, and inflation stays elevated.
What do you see as the drivers for growth this year? Do you Agree with the chair on what he sees driving the economy for 2026?
We do. I think there's certainly momentum in consumer spending. Upper income households in the U.S. have tremendous balance sheet strength, primarily because of increases in financial and real estate wealth. So very strong wealth effects for upper income consumers. That tends to be persistent. So that's part one. Part two is AI related business spending. That continues apace. We think that'll make a meaningful contribution to growth. And then third, the One Big Beautiful Bill Act will on net provide stimulus to households and corporates. We think that bill will add about 0.4 to growth in 2026. So those are the three pillars: resilience of the consumer, AI-related business spending, and then fiscal support.
What do you see as a path for the rate cut this year? Most are thinking there'll be one in June and then one at the end of the year.
So that's we have penciled in June and September. I think, given the strength in the economy, at least what Powell's words were suggesting about their upgrade to the outlook, I do think it'll be hard for them to cut in March and in April. They won't have enough evidence that inflation's coming down. The labor market may not be weak, but I do think the door for rate cuts would open, say, beginning in June. We've penciled in June and September. I don't have a very strong view on that. I just think it'll be when there's evidence that inflation is coming down, then the Fed can cut rates further. Could it be September and December? Absolutely. Could it be June and December? Yes. But I think in the second half of the year, the Fed will be taking further steps to lower the policy rate.
Michael Gapin, good to have you. Thanks very much for giving us some of your time today.
Thank you.
Straight ahead, we're waiting for results from Apple. First quarter results are due momentarily. We'll get to them when we come back. Here are the stories making headlines today. Canada's trade deficit widened by more than expected in November. Data from Statistics Canada shows the country had a trade shortfall of $2.2 billion, total exports falling 2.8%. Gold has been the most significant contributor to the fluctuation, with large shipment decline to the UK, US, and Hong Kong. Both exports and imports of motor vehicles and parts also declined. Empire will be shutting down its customer fulfillment center in Alberta. Analysts say the $750 million write-down highlights that the returns from its grocery delivery business aren't what the industry expected. And the company CEO says the decision will ensure long-term growth and profit in its e-commerce business. Celestica, one of the worst performers today on the TSX. You could see stock down over 13%. Analysts highlighting the company's increased capital spending and its disappointing full-year outlook. Celestica boosting planned capital investment to $1 billion for the year. On the upside, revenue and profit in the fourth quarter beat expectations, driven by continued demand for AI data center technologies. Tesla shares down today. The EV maker reported a 61% drop in annual profit and also saw revenue slip compared to the year before. Tesla has been dealing with growing competition and has cut prices in a bid to boost sales. The profit decline marks the second straight one for the company. Tesla leaning heavily on bets in AI now and robo-taxis to drive growth in the future. We are getting earnings results right now for Apple's first quarter. Revenue coming in at $143.76 billion. So that's a 16% year-over-year increase. The estimate was $138.4 billion. That was the Bloomberg consensus. Earnings per share coming in at $2.84 versus $2.40 year-over-year. The estimate had been $2.68, so a big beat on the company for earnings per share. Product revenue, $113.74 billion. That's a 16% increase year over year, and the estimate had been 107.69, so it would be there. iPhone revenue specifically at $85.27 billion, 23% up year over year. 78.31 was the estimate. Apple is saying iPhone had unprecedented demand for iPhone in the quarter. Mac revenue also coming in at $8.39 billion. That's actually down over 6%. iPad revenue is up 6.3% year over year. Wearables are down actually 2.2% year over year. And then services revenue has gained 14%. So let's get into some of the numbers with Mark Sebastian, founder of Option Pit and CIO of Carmen Line Capital. Thanks for joining us today.
Good to be here.
The CEO had said the first quarter revenue could be the best ever for the company and best ever for iPhone. Is that what you're seeing?
Clearly, nice beat on the iPhone. Looks like they've made a pretty nice recovery in China. This cycle did draw in some new people to upgrade their phones. We've been noticing that upgrade cycle kind of stretching and stretching and stretching, and this version with AI-enabled iPhones clearly brought some people to upgrade earlier and tighten the cycle back up a little bit. You add in the increased cost of the phone, and then again, expanding into China and overseas, and you end up with a really nice revenue beat almost entirely from the iPhone. Because the iPhone, the revenue there about $85.27 billion. Estimate was about 78.65. But look at the misses. They missed on Mac. They missed on wearables. Services revenue. Now, that's one that keep in your head. And then they had a small beat on iPads, which is kind of interesting. I don't know a lot of people that are still going out buying iPads, but, there continues to be demand for people laying in bed watching movies and stuff like that. But they're really, the iPhone is what, 58, almost 60% of the revenue. That's really what matters to Apple. Similarly to the way PC and server sales are going to matter to like Adele.
Okay.
And that's one of the things I think people need to start recognize with Apple is that they are essentially a hardware company selling one particular piece that really drives the revenue, and that is the phone. Services is the other area where they can draw on a lot, and they've had some court rulings that have not worked in their favor, and that might be part of the reason why their services revenue is down. It's courts, now this is an appeal, but if they lose this case, it's going to be a problem for them. Their ability to kind of take a piece of all the revenue of their different apps, that's really what that service revenue is. That is going to be dramatically affected by that court case. So that's something to keep a watch on.
Yeah, you mentioned correctly that this is a company that is essentially a hardware company. It relies very much on the sale of the phone, which is popular. Where is it going to pivot moving forward? Right now, they're using Gemini for Siri, as you mentioned. This is AI-enabled. Is it only a short-term AI fix? Does the company need to develop its own system for AI?
I think they needed to be developing their own system 3 years ago. Look at what the performance difference between Google getting Gemini right? We know they flubbed Bard, but look at them getting Gemini right and the growth that they're getting in there, what it's done for search, what it's doing on an Android, and frankly, what it's doing within the iPhone for Google versus the growth that we've seen in Apple. And this is where I think they really flubbed. There's some belief that Tim Cook, the CEO of Apple, kind of thought AI might become commoditized. We have not seen that happen yet. Maybe he'll be right 5-10 years down the line, but near term, AI has really become kind of its own thing, and it has not commoditized at all. We've seen Google really catch a massive increase in market cap because of the advances they've made generating their AI. And Google's paying a pretty penny for you to search use Gemini on your iPhone. Why are they paying that?
Yeah. Because
it's worth it to them.
Okay.
And the fact that Apple didn't get involved, they had opportunities to get involved with Anthropic or ChatGPT or any of the other different services out there, and kind of took a pass. And I think that's going to cost them long term. And my biggest issue with Apple is that they've really stopped innovating. Yeah, they make the phone better, but think about refrigerators and other gadgets or other things that you buy. How often, now they've got a longer shelf life, obviously, but, at what point does that stop being the revenue growth that it should? How many more advancements can you put into it?
Okay, so that leads me to the next question.
Yeah.
Then what else do they have, up their sleeve, and could it be a boon for them? Foldables is the big one people have been talking about.
I mean, your guess is as good as mine. So far, I haven't seen anything. The watch has been fine, but it certainly hasn't moved the needle the way they thought it might. The goggles, ask Meta how's that going. They need to come and, congratulations on AirPods. Like, I haven't seen any real innovation out of Apple in 10 years outside of their ability to innovate financial engineering. Tim Cook has done a beautiful job of managing buybacks, managing debt, managing dividends. But when you look at what they've under their actual business, when was the last time that you said to yourself, wow, this Apple product is really unique?
Yeah. We do buy new phones, but you're right. It's taking us longer to get there to get them. Got to leave it there. Mark, thanks for joining us. Mark Sebastian is founder of Option Pit and CIO of Carmen Line Capital. Up next, small caps back in the spotlight after outperforming the S&P 500 this month. More in a moment. U.S. small caps back in the spotlight. The Russell 2000 wrapped up its longest run of beating the S&P 500 in about 3 decades. And there is growing belief on Wall Street that the momentum isn't fading anytime soon. Let's go to Bloomberg's Michael Regan on this. He's managing editor for the U.S. equities team. Michael, thanks for joining us today. What would you say was driving the rally?
Well, there's a few things. I think it's interesting that streak of outperformance, the 14-day outperformance versus the S&P 500, as you point out, the longest streak of daily outperformance since 1996, coincided right with the beginning of the year. So I think it's clear that, as investors, started to position their portfolios for the new year, they were looking to maybe reduce exposure to the large caps, especially, we've heard so much about that concentration risk in the S&P 500. The 6 or 7 biggest tech companies really taking on a bigger and bigger portion of the S&P 500. So, we've seen a rotation into a variety of different other sort of sectors of the market and some underperformance from those big AI-exposed mega caps at the top of the weighting of the S&P 500. So I think that was a big part of it. But the economic fundamentals really sort of underpin the idea that small caps could continue to outperform as well. Just, an economy that is still humming along despite, sort of lukewarm job market, but that GDP growth is good. Interest rates poised to possibly come down, with the next Fed chief presumably being a Donald Trump pick who favors lower interest rates. And, small caps tend to be heavily indebted. So those lower interest rates or the prospects, potential for lower interest rates are a bullish signal for them on top of everything else.
Okay, the regional banks are a big part of the move, but why do you think that is?
I think they're simply a really convenient way to express this bullishness on small caps if you're so inclined, in large part because of that solid economic growth, the chances for further deregulation in the U.S. financial sector in a Trump presidency, but also that yield curve that's so important to banks has been steepening. In other words, the longer dated yields are much higher than the shorter dated yields as people expect the Fed to reduce rates. But we really haven't seen inflation be completely tamed. So that's really, creating this environment where banks which borrow, in the short term in the form of deposits or short-term funding markets are paying less than what they're making on loans. So, for small cap banks that don't have, exposure to that credit card industry that is, there's a lot of clouds over now under the Trump administration. It's a way to really express that potential higher profit margins from both the stabilizing, strengthening economy and that steep yield curve that benefits their net interest margins.
Investors think this is a trend that will carry on for the year. Why is that?
I think for a lot of these reasons we've said, the economy is strong, interest rates could come down. I will say, it's interesting. We did have this 14-day outperformance. Over longer periods, small caps have really not consistently outperformed the S&P 500 in more than a decade. They had this glory period from about 1999 to 2014. They didn't outperform every day. They didn't outperform every month or year. But if you bought small caps in 99 and held them to 2014, you outperformed the S&P 500 handily. Then we had this long period since then of underperformance, a brief spurt of outperformance during the pandemic. But, from 2014 till the end of last year, very, stark underperformance for small caps. So a lot of strategists, a lot of investors have really been bracing for that tide to turn the other way again and have an extended period of outperformance for small caps. Time will tell if this is really the beginning of that, but it is something people sort of have been hoping for a long time just because of this more than a decade of underperformance.
Michael, got to leave it there, sir. Thanks for your time. Appreciate it. When we come back, we'll get more on Toronto-based company's development of AI for autonomous trucks and robo-taxis. Back in a moment. Autonomous vehicle company Waabi claiming over $1 billion in investment funding this week, including a deal with Uber to power robo-taxis with its technology. We spoke to founder Raquel Erdison.
We are the leader really globally on self-driving trucking, which is, really exciting to be doing this from Canada. And what, since 2023, we've been doing commercial operations in the US, in Texas, where you can really see our self-driving vehicles, driving freight for some of the biggest, shippers and carriers in North America. And what, now the company is really ready for entering the next market because our autonomy system is really performant, is ready for driverless. And what is really exciting about the technology we have is that the same brain, the same AI system is going to drive both robotaxis as well as self-driving trucks, which is, for the first time in the industry, enabling us to really have a very fast and seamlessly entry into the robotaxi market.
All right, Gavin, do you want to join the conversation?
Yes, just to say, obviously you're operating very successfully in the States. Do you have any plans to come to Canada? Is the market more open to using autonomous vehicles, more receptive, shall we say?
Yeah, fantastic question. Definitely, I would love to bring this technology to Canada. Obviously, it's a smaller market than the US, but I think the key differentiator here is that the regulatory framework in the US is way ahead of Canada. That being said, we are working with the regulators in order to, make it possible for us to safely deploy the technology here as well. So definitely, it's our intention to come here as soon as we can.
And now let's go back to let's talk about the taxis now, the auto taxis. Uber, you worked for them. Did that help with this work this deal out? And will it be easier to integrate your technology with them because of that?
Yeah, so we had, we announced a massive deal with Uber, right? We're going to be deploying more than 25,000 robotaxis on the Uber network. So definitely bringing, robotaxis globally to the next level of scale. And I will say that, Uber has been an investor in Waabi from day one. They invested in our Series A, they call it our Series B. Now they also invested in our Series C. And they have really seen, what, our technology can do. And what you see with this, massive robotaxi deal is, their excitement, and they are, tripling down, if you wish, in terms of, really Waabi being the provider for the Uber network. They can and really bring robotaxis to the next level. Now, the fact that I work at Uber before doesn't necessarily, it's like, tertiary, I will say, in terms of, the reasons why Uber invested. First, because of our technology that they have been seeing, over the last 4.5 years. And then there is obviously, knowledge of the board, data, et cetera, in terms of knowing personally myself as well as our CEO, Leo Ron, over the last decade.
Now, and are you playing catch up Waymo's out there? Are you playing catch up with them, or do you think you can catch them?
So we definitely believe that we can catch, everybody in the industry, right? And, it's all about, we have a very differentiated technology that is a big advantage. We have the next generation of tech that can really enable us to swiftly and really efficiently come into the robotaxi market. And it's a massive market, right? $1 trillion just in the U.S. alone. So definitely there is more than a space for Waabi to have a big market share, in the years to come. So we feel very, very confident, and with this partnership with Uber, we have all it takes to really deploy the technology there. And I think it's worth mentioning as well that, unlike the rest of the industry in self-driving trucking, our trucks today have the ability to drive on surface streets, on urban environments. And so we already have all the core capabilities for robotaxis as well. So all this together, make for us a no-brainer that now that our self-driving technology is ready, right, for trucks to really enter this new market.
I just want to sneak in one more question, then I'll let Gavin have the last question. You called it teacher-student architecture for the driving. Is that what makes it different than other companies?
So we have the only verifiable end-to-end system that is capable of reasoning. And what it does is two things. One is that we can actually prove that the system is safe. And we have, being able to utilize the full power of AI and the system through reasoning really generalizes to things it has never seen before, and is able to learn extremely efficiently. So this together with our simulator, which is, we build the metaverse for self-driving, which is the best simulator in the industry, enable us to teach the system and test the system, to perform better than humans in any situation, including, unavoidable accidents, any safety critical, situation on the road. So this technology advantage really has propelled Waabi. I started the company only 4.5 years ago, and our system is really already ready to drive super performance, right? And we are ready for the next stage and the next vertical, as I said, robotaxis. And you will hear more about our plans of when we are entering the market, roadmaps, etc. But what I can share with you today is that it's going to be much faster than anybody believes.
Raquel Erdison, CEO, founder of Waabi. A recap of how we ended the day and a couple of earnings after the bells. Apple sharing its latest quarter. Shares of Apple trending higher in the after hours after that company reported a record revenue because of their iPhone 17 sales. They're just skyrocketing. Growth in services and a rebound in China helping them as well. Let's get to Visa. It reported as well after the bells, and their Q1 earnings topped analyst estimates. Payment surged for Visa at 8% up from a year before. They had strong holiday spending sales. Investors, though, they're not that impressed. Shares, as you could see, dropping in after hours trading. And a quick look at where we landed the day on Bay Street and Wall Street. The TSX Composite at a 159-point drop, almost half of 1%. The S&P not a material change. The Nasdaq a 172-point drop, 0.7 of 1%. That does it for us on The Close today. Thanks very much for joining us. We'll see you back here tomorrow.